Hey, it's Jeff Hyman with Startup Therapist, and I'm here with Brian Ascher, partner at the legendary venture capital firm Venrock out in Silicon Valley. Hey, Brian.
Hey, Jeff.
Thanks for having me. Thank you so much for making the time today. We appreciate it. Most of our watchers are entrepreneurs or founders. Some of them want to start a company, but most of them have actually started. And so today we're going to talk about things from the perspective of a venture capitalist, a VC. You've been doing this, 18 years now or so?
Yes. I don't know where the time went.
And we worked together ages ago in product management back at Intuit. Did you work on Quick in there?
I did. My first day on the job, I had to write an apology letter to a bunch of users who received software that had a bug in it. We had to send floppy disks.
Oh, gosh. Now you're aging yourself. You're dating yourself. So you have a product kind of DNA. You come from product. You love product.
Yep.
And you brought that to venture capital, and you've been doing it coming up on 20 years. So safe to say you've seen this movie a lot of times. And what I thought we'd talk about today is kind of how VCs work with entrepreneurs, some of the challenges, what you look for in an entrepreneur. Sound good?
Sounds great.
Why don't we start with that question, which is, you see many, many deals. I'm guessing thousands of deals a year potentially, and you invest in just a small handful. What is it that you look for in the founder, the entrepreneur or co-founders? Not the business, not the concept, but the team, the person, right. the guy, I guess some people would call it. What do you look for?
Yeah. Well, first, I think smart is a given, right? Smart is table stakes. There's a lot of smart people out there, but it's more than that. We have a phrase we call force of nature. Someone who's just so tenacious and energetic about their idea and resourceful that they will walk through walls to make it successful, kind of do whatever it takes. That's really the key ingredient. Second would be a mental agility to realize that though they will walk through walls, they will modify where they're stepping on their way through that wall to get around the pitfalls and to respond to market feedback and remain mentally adept at bobbing and weaving their way to the right answer. And then last point would be having this duality in your thinking that lets you be really pragmatic about the current challenges you're facing and a willingness to admit that, yeah, there's a bunch of problems that need solving every day, all day, but really optimistic about where you're heading and that eventually this is going to be great and you're heading in the right direction, and it's a huge opportunity. If you can hold both those things in your mind at once, that's a really key attribute of an entrepreneur.
Is that a small percentage of entrepreneurs or founders that you see that are able to maintain that optimism, but at the same time, ability to be flexible and change their plan?
It's hard. Yeah. I don't think everybody has that innately in them because you either get so down on the current problems or you just tend to gloss over them and not recognize them. And if you're not recognizing them, you're not solving them.
So what do you look for? So I understand the characteristics of what you look for. How do you look for it? So once you're working with them and you've made your investment, that's one thing. But how do you reference or background an entrepreneur to know if they have these characteristics?
Yeah. I developed a bit of a heuristic for myself, which is I know I'm in the presence of one of these forces of nature when I'm in a meeting and I'm asking, all the tough questions that are coming up based on whatever the subject is, and the entrepreneur responds non-defensively with compelling answers, and you leave that meeting and you feel just jazzed. You're excited. You're like, this person is thinking about all the things that could go wrong. They don't have answers to everything, but they've thought of most, and they know what they don't know, and they're willing to admit where the risks are. So if you feel good, like in that next hour after that meeting, you've met someone great. Then you load up on more questions. Oh wait, I've got to ask this.
Right.
And the same thing happens.
So they're able to inspire you. If you walk out inspired, then you figure they can probably inspire customers and employees and that type of thing.
Absolutely, and take challenges head on without getting all defensive or dismissive.
What about when you ask them a question they don't know the answer to, they haven't thought about it, or there is no answer, it's unknowable, and they say, I don't know. Is that a valid answer, or?
I think so.
Yeah.
I think it's a sign of intellectual honesty, particularly if it's something that they should know and they come back and they know it, within a few days. That's terrific.
Yeah.
If it's something they should know and they don't know it and they don't go and figure it out, well, you can guess how that goes.
How about this first characteristic you mentioned, people that kind of run through brick walls, they don't let anything stop them. How do you assess that? What do you look for in their background that would demonstrate to you possibly that kind of person is in your presence?
Yeah, I don't know that I have a great answer by looking at a resume, but it's generally associated with a really high personal energy and a positive outlook that really just, it comes across when you're with them face to face. You just know that this person, wakes up every morning, kicks the sheet off the bed, and is ready to tackle the world. And those people are super rare.
Yeah, they're hard to find. Where are you on the founder, co-founder debate? Some people swear they will not invest unless there's multiple founders. Other people tell me I really prefer to have one throat to choke.
Well, I do believe that these businesses are really hard, and having a partner in crime is important. So I don't have a rule book, one or the other, but I do think two co-founders has worked out very, very well in many, many cases. So I think that's the preferred route. Now, you do need one CEO.
Yeah.
So as far as someone who's ultimately accountable for the fate of the business, it is a good idea.
What's a good combination if one is the CEO, is the other often head of product, head of sales? What do you find works best?
Well, I think pair of technical and then business oriented, and sometimes there's a lot of overlap between the backgrounds or skills, but someone who's taking responsibility for the go-to-market and someone who's taking responsibility for building the product is a great balance.
Got it. Okay, so once you've made your investment, you've cut the check. Your typical investments range. What does Venrock often do these days?
Yeah, 5 to 8, sometimes 10 million in a first investment, and then we'll follow on, but usually roughly the same amount over the life of a deal.
Okay, so these are large checks.
Yeah.
How do you know when there's a problem? What is the first thing you smell that says, we've got Houston, we have a problem, and you need to potentially have a tough discussion with the entrepreneur?
Yeah. Well, the first thing is a recognition that there are always problems, and it's not a surprise that there are problems. We view our work here as every day we go and we solve problems. It's not to cheerlead all the successes, and hopefully there's plenty of those, but to be better and achieve higher goals, it's to focus on the problems. And the first thing I try to do in a new relationship with an entrepreneur is explain that there's a positive communication loop and a negative communication loop. The positive loop is one where we have enough mutual trust that the entrepreneur is willing to come to me and say, here's a problem. And, it could even be, the school of thought which says, don't tell me about problems unless you have a solution.
Yep.
I don't necessarily believe that. If you're identifying a problem early, let's talk about it and figure out the solution, or, let's make a plan to get a plan. So be transparent about the problems. And then we'll trust each other that we're being realistic about the challenges we're facing. Then let's solve it. And then there's that feedback loop of, okay, this worked out okay. I had a problem. We solved it together. I'll give you early warning on the next problem.
Yep.
That's a great relationship.
And I assume you have to start that early in after your investment.
Absolutely.
Yeah.
Absolutely. The reverse is where there's a problem. I'm not telling you about it. I'm covering it up. At some point, you start to sense as an investor that there's a problem, either by seeing the results or something's just not adding up in the reports you're getting or the discussions you're having, and then you start to doubt. Well, what else don't I know? And then you start to dig harder, and then they get more defensive, and then ultimately the problem, erupts, and now there's mistrust about why didn't you tell me sooner. And that loop spirals out of control, where there's a lack of trust and transparency.
What drives, in your opinion, what leads founders or entrepreneurs to hesitate in bringing problems to their investors?
Yeah, I think it's a two-way street. Number one, you do need to have the confidence to say, okay, they have invested in me. Like, I'm not risking the decision to get their money or get their involvement. That's already happened. So now we're really on the same side, working towards the same goal. And I can share a problem without disappointing them or freaking them out or having negative repercussions for me. And I say it's a two-way street because then it's the investor's obligation to not freak out, to be constructive,
Right.
to not make the entrepreneur feel bad for having come to you with a problem, but say, I get it.
It's like encouraging your kids to come to you when they smoke pot the first time. You can't yell and throw phones. They're never going to come to you again with another problem.
Instead of driving drunk, call me, I'll pick you up.
Got it.
Like, it's got to be the same thing. We got to make a safe environment to solve problems together.
Got it. And then how many of those problems or such discussions do you have before you say, we might have backed the wrong horse, or we need to think about potentially changing the team?
Well, team members you're constantly upgrading team members, and that's one of the key things that I've learned over my time doing this. And it sounds obvious. I want to take this beyond the level of a platitude.
Yeah.
Because you always feel like you got some good people on the team, and there's never a convenient time to replace your VP of sales or your CFO. Yeah. But if you're not constantly upgrading the team to where you feel like you truly have A players in every single slot, then you're not achieving your full potential. So I view that as a constant in almost every situation.
Is that the most important job of the founder, CEO?
I think so. Is to be developing their team and also make sure they don't run out of money. So they got to be good at fundraising and doing that. As far as the founder replacement, hopefully it never comes as a surprise. It's a constant iteration on what are the challenges the businesses are facing, where are the skill gaps that the CEO or founder needs to keep growing and maturing as a leader, and hopefully as the company grows and scales. And it can be a constructive discussion of when they've reached their limit. And it doesn't always work that way, but many of the healthiest situations, it is a two-way street.
What percentage of the time does that happen? So I don't know if there are any metrics, but maybe just your gut. After 3 years after an investment, what percentage of the time is the founder or original CEO still the CEO?
Oh, I'd say at least half, probably more like 2/3.
Got it. So a third of the time there's a change within the first 3 years.
Yeah.
How do you know early on, and how do you help the entrepreneur understand that really is the best thing for the business? How do you get the ego out of it?
Yeah, it's hard, but I think it's greatly facilitated by having this trust loop started early around the problems and the challenges, and hopefully you're bringing in team members that are so skilled and experienced that they start to see, okay, I now know what an experienced VP of sales does, or VP Eng, or CFO. I get the value of, bringing in a CEO.
Got it.
That, and it's not the old mantra of, let's bring in adult supervision. I think we've all learned that was a flawed model.
Yep.
But it doesn't mean that there aren't other folks out there are better suited to scale a business.
So if the problems continue to be in the same pattern or same theme, you may help the entrepreneur realize that he or she is not the right person with that set of problems to solve that set of problems.
Yeah, and hopefully there is still a role within the company, or sometimes, great entrepreneurs are great at that starting phase and, from 0 to 50 employees or what have you, and they get, the sense that, hey, we're now a couple hundred people. This isn't fun. I want to go do something else.
So along those lines, let's talk a bit about stress, anxiety, depression. We had a recent interview with Brad Feld, who who's dealt with his own depression publicly, but talks a lot about entrepreneurs and the unique stresses and depression that many of them face. Is that something you've witnessed either with your portfolio companies or companies that maybe you didn't invest in? What's your take on that? And what can founders do to alleviate these issues?
Yeah, no, it's a really great topic and a real sensitive question, particularly in this moment in time where we've had 6 years or so of really strong markets and unicorns and growth. And if you judge your insides on other people's outsides, you'd feel terrible because it looks like everyone else is killing it.
Yeah.
You know, the quote that entrepreneurs use with each other, and you're going to work every day, you know, fighting fights and battling, you know, challenges. And the reality is everyone has that. Even the companies that look like they're, you know, beating the world are doing so by fighting the fight every day. So it's hard everywhere, regardless of what, you know, the press from the outside looks like.
How does an entrepreneur know when they've got a problem, they're heading down this dark path, and what can they do about it? Do you ever have conversations with your entrepreneurs to help get them out of that muck?
You know, I do try and strike a balance between, hey, let's focus on the problems, but make sure that, you know, there is a visible recognition of all the positive things we are achieving and the good work that's been done. And sometimes a simple thank you, you know, can go a long way to realize that, hey, even my investors, you know, realize though things aren't going well, they
Right.
really appreciate the time and effort and personal sacrifice I'm making to do this. And one of the things you can do as an investor is make sure that you likewise are putting the time and effort in, and you're accessible. And if you are getting, you know, you're available by phone, you know, 24/7. You'll respond to
Yep.
emails quickly. When they ask to schedule a meeting of the board, you make it super easy for you to be available, and you juggle things so that they realize that, hey, you work hard too,
Right.
and that you know, business is hard and requires, you know, real-time responsiveness.
One of the things that we talk a lot about with founders is that, you know, many of them feel like they live in the shadow of Steve Jobs and Mark Zuckerberg, and it's hard to feel successful when you've got those, you know, those one-off data points that the media celebrates. You know, the new Steve Jobs movie is coming out shortly. The Facebook movie was a smash hit. How do you explain that phenomena, or more importantly, how do you help entrepreneurs realize that those are not necessarily the role models that you're going to aspire to, because they don't happen very often?
Yeah, no, they don't. But it's sort of like you're the best at being you, and your company is, you know, it really comes down to, do you believe in the mission? That what you're doing matters. It feels good. It's making the world better, and better doesn't have to mean curing cancer or, you know, solving the world's energy problems. It could just be delighting customers and whatever value you happen to provide as a business. And if you're inspired by the mission, then I don't think you're necessarily going to worry that you're not Mark Zuckerberg or, you know, Steve Jobs. And in many respects, you know, their missions, while very important and loved by billions, aren't necessarily the cure cancer and solve the world's energy types of missions. So I'm sure lots of entrepreneurs are doing work that to them, or maybe even to most people, is more meaningful than what those entrepreneurs did.
Last topic is going back to the very beginning question, which is funding in the first place. Bootstrapping versus taking outside capital. How do you know when you're ready to take outside capital, etc.? How do you kind of think about that? How do you know when an entrepreneur or a startup is ready or should even take outside capital?
Well, that's a really important point, because I think there has become more of a default assumption that, you know, if I'm in a tech business, then I raise a seed round, and then I go for A, and then I go for B, and then I go for C, and then I go for a growth round, and it's all, you know, becomes a bit of a treadmill.
Yeah, it's kind of planned out for you.
The bar keeps going up and up and up to the type of, you know, ultimate exit you would need to make investors money and hopefully make the journey worthwhile financially for you as well. And I think there's definitely, as the costs of developing products and getting into market have come down, it's made it more viable to have more of a bootstrapped model, or a, you know, angel seed round, and then, you know, financially self-sustaining kind of models are more and more viable. And so I think it is very much a first decision is, you know, do I need any outside capital? Most of the time you need some. And so that would be a seed round, and that's fine. But from there, I think it's a pretty big question to decide if you're going the venture route or not.
And how do you help entrepreneurs decide that? Or when you see startups, what is the heuristic you would say they shouldn't raise money? They should go it alone?
Yeah. I think a lot of times you feel like it might just be a small market or a small idea. And therefore, even if you raise a bunch of capital, it's probably not going to be the scale of business that's going to be standalone. This is going to get acquired, or it's going to be, it's going to tap out at $10 million, $20 million revenue.
Right.
It'll
be a product, not a company.
Yeah, exactly. We hear that, right? It could be a feature, not a company. Could be a product, not a company. Hopefully, it's a company.
Right.
If you're going out for a bunch of venture capital.
So would you go so far as to say that the default for founders should be, how do I not raise capital, or versus what you described, which is the current default, which is you just go out and raise money?
Yeah.
Do people have it backwards?
I think the default assumption should be I need to preserve optionality. I need to be in a position where I can more or less control my own destiny. Mm-hmm. So that may mean that I'm going to need to raise a whole bunch of capital, but I've broken down the business and the milestones, and I'm able to reduce risk each step of the way. That raising capital will be, money will come to me.
Yes.
I don't have to, run out there, in a panic as I'm about to run out of my last dollar.
Right. That's when you know it's time to raise money, when you don't need it and it's finding you, right?
Yeah, when you've achieved enough milestones that you're now at a different valuation level that you're making progress, making money for all investors and minimizing dilution to you and your team.
Great.
And the reverse is also true, which is, hey, maybe I'm in a position where I'm truly self-sustaining. I can fund off of revenue, and I'm going to choose not to raise capital.
Right. Great. That's very good advice. I agree with you. I think many entrepreneurs do kind of have it backward in terms of their default assumption.
Yeah, fundraising is not the goal.
And maybe it's a Shark Tank mindset that's kind of taken over.
Yeah.
From the TV show. Well, thanks for your time. How do people get in touch with you, or just to learn about Venrock, or talk to you about particular startup ideas?
Yeah, our website is venrock.com. I have a contact me link there. My Twitter handle is VCSurferDad. Pretty much got all my priorities right there.
Yeah.
Handle.
Not in that order, though. It goes Dad, then Surfer, then VC. Good. Well, thanks for making the time, Brian. We really appreciate it.
You got it, Jeff.